You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means it must be Wednesday. It's education time here on the old Options Insider Radio Network. That means it's time once again for Options Bootcamp, the premier education program for you out there. The basic retail stock trader. Maybe you're thinking about dipping your toes into those options waters. Maybe you've already done so. You want to maybe perfect your technique, learn a little more so you can head on over to the deep end of the pool. Either way, we got you covered. My name is Mark Longo from the aforementioned network, as well as, of course, from theoptionsinsider.com. Place you guys can go in between episodes of this fine program to check out unusual activity, a lot of earnings move and earnings move results reports, all that stuff available for you guys completely for free, courtesy of our friends in Orat's Land. A lot of great data there that you can't really get anywhere else, and we got it there for you completely for free. And, of course, if you like what you hear, keep those comments coming on our platforms of choice, those reviews, so new people can continue to discover the program. And indeed, you guys have been doing so. I thank you for that because the numbers for the show are just off the charts. You guys are loving it. Clearly, you guys liked yourself a little bit of expensive puts last week. So you guys are on fire with the show. We're happy to keep up with all of your demands. Remember, if you like what you hear, keep those reviews coming so new folks can continue to discover this program in these trying times. And if you have a question, maybe a comment, maybe you got issues with Dan, hit us up. We do like to hear from you guys. And speaking of the guy you have issues with, I'm just kidding. He's my cohort, my partner in crime, the black-hatted one himself, Mr. Dan Passarelli, the founder over there at Market Taker Mentoring and the author of one or two options-oriented tomes. Mr. P, welcome back to the Options Bootcamp Drill Instructor Proving Ground, sir.
It's always good to be here, Mark. Glad to be drilling.
Let's get drilling then. Let's get right to it. A little bit of the old basic training.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Pull in, prepare to learn. Yes, sir.
An oldie but a goodie. That might be one of the oldest and constantly still serving transitions here that are still running here on the network, but it brings a smile to my face every time we hear it. Welcome to the basic training segment, the portion of the show where we break down some basic options concept and explain how you can utilize it in your own portfolio. And Dan and I, as we are wont to do before the show, we're kind of brainstorming, like what would be an interesting topic, looking at some of your feedback, things that are interesting to you guys. And Dan hit upon an interesting nugget that I think it's worth revisiting here on the show. Again, we touched on it, different aspects of it in the past, but let's dive into it again because it's one of those topics that keeps rearing its ugly head out there. It is, of course, gamma scalping, Mr. P. That term sounds scary. Whoa, gamma scalping. What the heck is that? Is this the Hulk? Is the Hulk going to come and attack me now? We're talking about gamma. So, Mr. P, since this was your suggestion, I'll let you take the reins, sir. What the heck is gamma scalping? Why should I care about it? When should I use it, sir?
So, it's sort of a trick question that I set up for you there, Mark. When should you use it? Never. Crazy thing. But when I get students who are in our Smart Trade Workshop online education series, who are some of our top students, I go into gamma scalping extremely deeply. And I preface it by telling them this crazy thing that sounds so ridiculous. You're never going to use this, but you need to know how it works. If you know how gamma scalping works, you have a deep understanding of volatility and what it is and how it works and why it works that way and who influences it, and you become an extremely better trader.
All right, so let's break it down. So you obviously wrote a few tomes on the Greeks, gamma. Obviously, one of those Greeks, if you remember, listeners, it is, of course, the rate of change of your delta as the underlying moves. So if you're not familiar with your basic Greeks, maybe check out some of the earlier episodes of this program to get familiar. Or maybe, of course, check out Dan's books on the subject as well. Dan, I got some gamma. I want to scalp it. What the heck do I do?
All right. Well, let's start at maybe the beginning of the story here. Like, what is gamma? Like, you gave a great definition, but like, how do I get it, and what are the implications? What does this all really mean? So here's the thing. Let's take a step back, look really high level at this, and there's this idea that like when the underlying stock price changes, your delta changes. Now, at first that might seem like, okay, this is trivia that I can remember, yeah. But no, like, it's really super intuitive. When you think about it, like, deep in the money options have big deltas, right? Close to 100. Far out of the money options have little deltas, close to 0. So when the underlying stock, and at the money options have close to 50. When the underlying stock changes, options are always becoming more in or out of the money. Consequently, their deltas are changing. So like that right there in and of itself is relevant to people just to understand, like, aha, oh, okay, so this can make sense to me. How do you get it, and what implications are involved there? Well, look, so this is really easy to remember. And for a lot of folks who are basic to like starting to get to intermediate, here's all you need to know about gamma. Spoiler alert for you more advanced folks, we're going to really get way into the weeds in a minute. Whenever I buy an option, I have positive gamma. Whenever I sell an option, I have negative gamma. Positive gamma is good. Positive gamma helps me. Positive gamma means that my delta changes in my favor. And like that is true for any option position. In fact, like let's just take like buying a call, like the most rudimentary position out there that everybody starts with. Hey, I bought a call. Look at me, I'm an option trader. If you buy a call, if the stock goes up, you'll make money. If it goes up a lot, you make money at an increasing rate because whatever your delta was when you bought that call, when the stock's higher, the option's getting more in the money, and so therefore the delta gets bigger. So I'm not only am I making money, I'm making money at an increasing rate. That's beneficial to me as a trader. If I own this call and the stock goes down, well, I lose money intuitively, right? But the option is getting more out of the money or less in the money as it may be. So that means my delta gets smaller. So yes, I lose money when I own a call and the stock goes down, but I lose it at a decreasing rate, which is beneficial to me. And then it's the opposite with being short options. If I'm making money, I'm making at a decreasing rate. If I'm losing money, I'm losing it at an increasing rate. So, okay, I'm going to run out of breath, and I know that Mark likes to talk a lot. So I'm going to give Mark a chance to talk. Take a sip of water, maybe go downstairs, make some tea with some honey, gargle, and come back and give you guys the advanced stuff.
I got nothing. I'm done. That's it. I don't know what you're talking about. It's like I get paid to talk or something. But of course, you broke it down for us pretty well there, Mr. P. Again, if you have questions about all the Greeks, I encourage you to check out early episodes of this program, or indeed Dan's book on the subject. Let's go through a quick example if you're a little bit confused. Remember, you come in, you buy that call, XYZ, the hot stock everybody's got to have. Maybe it's about to announce a 5-for-1 stock split or a 4-for-1 like Apple and Tesla have done of late out there. You buy an at-the-money call. Remember, at-the-money calls have a delta of around a 50, listeners. So you buy an at-the-money call, you got a delta of 50. But let's say in this scenario, it's also got a pretty high gamma because it's an at-the-money call. Remember, at-the-money is going to have high gamma, high theta. That's the other part people forget. They like to have a high gamma because it means their position's going to move a bit, going to rock and roll a little bit, but also the flip side of the high gamma coin is high theta. You can't really get one without the other. People have devoted many hours and years of research analysis to try to find a way to get one without the other, but you really can't. They kind of go hand in hand. They are inextricably linked. If you're going to have high gamma, you're going to pay for it with high theta. This used to encounter us all the time on the trading floor. We'd end up with these residual positions that were frequently long gamma because that's what the customers were doing. They were dumping options to us. So we, as market makers, had to defend those positions pretty aggressively, and that's where gamma scalping came in. That's where it could be handy for you as well. So let's go back to our example here. You buy this one XYZ call, hot call, at the money, 50 deltas. It's also got a gamma of 50. What does that mean in this very straightforward example? Well, if XYZ moves a point, then that gamma is going to increase your delta by another 50. Now you have effectively a delta of 100 or a delta of 1, depending on your nomenclature of how you like to refer to it, which means you have effectively 100 shares of stock in your position from a delta perspective at this point. So now what do? Your stock has rallied. Your delta has gone from 50 to 100. You're sitting on nice 100 juicy shares of underlying effectively. And you're like, man, what can I do? What can I do? A couple of things. You can close it out, take your gains. That's always a winning strategy. That could work. You could also keep it as is and think the underlying party is going to continue. The rally is going to continue. Now you have 100 deltas, so you're going to move tick for tick with the underlying. So you're really hoping that party continues. And if it explodes to the upside, bam, you're off to the races making money. Or you can do what we used to do on the floor, which is you would delta hedge it. So you come in now and you're long effectively 100 shares of the underlying. You could turn around and sell 100 shares of stock. So keep the call. Sell 100 shares of stock against it. What have you done now? You made your position what is called delta neutral. You have no equivalent delta right now. Your delta is 0. So you have sold stock. Your long a call is 100 delta. They're offsetting positions. You sold stock. You hedged your delta. You did not hedge away your gamma. You can't hedge away your gamma using stock. So it's still there. So now let's say in this scenario, the stock turns around. The rally was short-lived. It drops another point. Remember, you still have that 50 gamma. In our example, the gamma is not going to change. We're just going to keep it constant. It will change in real life. We're not going to get that crazy for you here. So your gamma is still 50. It's going to drop back down. And now, of course, you have a call that was 100 deltas. The gamma drops at 50 points because you dropped a whole point. So now your delta is back to where you started at 50 on the call. But guess what you also did? You shorted 100 shares of stock against it. So 50 minus 100, guess what? Negative 50. You have a negative 50 delta now. So you're effectively equivalent of short 50 shares in the underlying. What can you do now? Well, a couple of things. You can close out that position again. Or you can do what we used to do, which was scalp that gamma. You buy back 50 shares of stock against it. Now your position, back to delta neutral again. Your delta is 0. And you have now just scalped 1 point on 50 shares, a.k.a. $50. You scale that up to a larger position, and you could see some of the value of this. Because otherwise, if you have a long gamma position, listeners, and you're kind of just bouncing, kind of just vacillating around a particular strike for a while, that could be very dangerous for you because you're not really getting the big move you need to pay for that gamma, but you're paying a lot of decay every day for that. So if you have a lot of long gamma positions, if you're a long options trader, it probably behooves you to at least understand what the heck we're talking about here with gamma scalping. So, Dan, does that example jive with you, sir? Anything you want to add there?
Yeah, no, I mean, that's a really great example, Mark. I mean, that covers it. There's clearly a whole bunch of devils in the detail, but, I mean, like I said earlier, you as a retail trader are never going to do this. The margin is too oppressive if you have Reg T margining, and even if you have retail portfolio margining, the margining is still a little bit oppressive. And I made that statement earlier, that you're not going to do this, but it's still useful. I mean, it's kind of like like if you're an avid reader, like you really like to read like classics, like you can just read a book and get into it. But like if you take a writing class, you learn more about like what goes into it and how certain techniques are used. Like you end up seeing all the stuff that the author put in there that you wouldn't otherwise have understood, and you just understand it more deeply and you enjoy it more. Here, it's kind of the same thing. We're digging deep under the surface to see what goes on really behind the scenes. And, it's not necessarily about enjoying it more. It's about, making more money. So that's why this is important. Now, so who does this gamma scalping? There's really two main groups, I would say. They're the market makers, who are liquidity providers, who are just kind of doing it to take marks or defend their positions. Partially, there's a little bit of volatility positioning that goes into it, which I'll explain in a second. But then also what we call volatility arbitrageurs, who have very, very low margin requirements. They're professional traders, and they go out there and look for volatility that's cheap, that's inexpensive. And we've talked about this a number of times on the show, but like this is where the rubber really hits the road. And when it is cheap, they'll go and they'll buy options. Now, what kind of options? Well, either straddles or synthetic straddles, because that synthetic straddles is basically what all gamma scalpers are trading. I don't remember if we ever had a show on synthetics. If we didn't, we should put that one onto the list too, Mark.
We have, but it's been some time. Probably worth revisiting that as well.
Yeah. So, and if I get too long-winded, Mark, feel free to cut me off. But when volatility is inexpensive, like here's how this really works. You have to kind of understand not just the options pricing model, but why there is an options pricing model. An options pricing model helps traders understand the factors that go into option pricing. It doesn't really give them the price of the option. The market does that. What it really does is tells them the volatility input that's factored into the model. And here's where the rubber hits the road. If I buy a synthetic straddle right now, and maybe there's 27 days left in the life of the option. Over the next 27 days, if the historical volatility ends up being greater than the implied volatility level that I purchased today via the options, I'm statistically going to make money. And that's not 100% universally true, but that's the concept we're dealing with here. If I buy a volatility level that ends up being higher than what future historical volatility ends up being, I'm probably going to lose money. I can get really, really deep into the weeds like that. I'm going to bounce the ball back to Mark, let him play a little bit, and maybe fill in some more detail in a minute.
I think we should, because you're right. This is a pretty advanced technique. It's primarily used by professionals. Like I mentioned, we used to use it on the trading floor as market makers, but then again, we had access to much more favorable margin and commission structures for slinging large amounts of stock than your typical retail did. So for us, it was a pretty easy, pretty low-cost alternative to use stock to hedge our underlying. As Dan pointed out, not exactly the case with a lot of retail. Now, you could do some approximations of this yourself. Some people in the retail space like to maybe take part of this off or maybe trade other options against their native options position, and they call that gamma scalping. I would just caution you that that is not the same thing, because now you've changed your fundamental structure. If you're buying or selling other options against this, you're going to change your gamma, you're going to change your delta, you're going to change your vega, your theta, everything about your position is going to change. So it's not true gamma scalping, which is really you're just slinging stock back and forth. And stock only has a delta, doesn't have any of those other Greek components for you to worry about. Speaking of nomenclature, Dan, before we roll on to some quick questions here at the end, we probably should clarify the difference between gamma scalping and gamma hedging as well, because gamma scalping pretty much for those on the long premium side of the fence, like we said, looking to defend against all that decay. But a lot of our listeners like to hang their hat on the dark side, Mr. P, kind of like you, the dark-hatted one, the black-hatted one. And so those folks are not really going to be gamma scalping, more like gamma hedging. Would you like to clarify the difference there, Dan?
Yeah. So So with gamma scalping, the idea is, again, really trading synthetic straddles. When the stock goes up, you're getting more positive deltas, so you sell stock to neutralize the delta. When the stock goes down, you're getting short deltas, so you need to buy stock to neutralize the delta. So basically, when it goes up, you sell. When it goes down, you buy. And if it oscillates back and forth, you're locking in profits. When you're short options, that's where gamma creates a problem for you. You have the benefit of time decay, like Mark pointed out earlier, but gamma is always working against you. And so when the market's moving farther and farther, you're getting these adverse deltas, and that's causing you to potentially lose at an exponential rate. And so then what you do is you trade deltas to neutralize that adverse delta to stop the bleeding.
Yeah, well said there. I mean, effectively, it comes down to listeners. When you're long a lot of options, long a lot of gamma, gamma is your friend. When you're short a lot of options, then gamma is your enemy, as Dan pointed out. So you're not really scalping to lock in profits anymore. You're trying to hedge to mitigate the bleeding, the loss of money out there, and how you put those hedges on. That's, of course, another scenario. I've talked before in the past on this show how I'm not a huge fan of technicals. And one of the things that broke me away from my technical analysis was attempting to use technical analysis in this use case, the long gamma scalping use case, which is a very specific use case. I will grant you that for all you technicians out there who take umbrage with that. But trying to use technical analysis to find levels to scalp your gamma was a very common, very popular, very frustrating use case on the floor of the SIBO, because how you worked your gamma scalps could often be the difference between a positive day and indeed a negative day. And the flip side is true really for negative gamma hedging as well. You obviously want to push those out a little bit, but the farther out you go, the more bleeding you're taking there. So that's a delicate dance, maybe a conversation for another day. Just remember, if you're short gamma at the end of the day, you're not scalping it. You're hedging it and trying to stop the bleeding. So there's a refresher for you, kind of gamma scalping 101, gamma scalping for beginners. As Dan said, it's probably not a technique a lot of you are going to do. And if you do, you're probably going to use options against it, which is not really technically gamma scalping, but we wanted to put it out there to clarify. We've had some of you asking questions about gamma. It seems to be a popular topic these days, kind of rearing its ugly head out there once again. So we thought we'd put it out there for you, the masses out there who are just chowing down an options boot camp these days. Speaking of the masses, let's get to some of you, a little bit of your mail call.
Mail call. Time to look at questions submitted by our listeners.
Oh, so festive, so lovely. Welcome to the mail call, listeners, a portion of the show where you guys take the reins, your questions, your comments, your feedback. Let's start off here. Oh, this name sounds familiar. It's a name that's kind of hard to forget. Dan, this is from our last episode, I do believe. Maybe it's our 100th episode, spectacular. But a recent episode. We had Austin Beerwinkle on the show. Remember that name, Dan?
Sure do. How do I forget?
Yeah, that's a great one. I assumed that was a nom de plume, a nom de option. We get a lot of those here on the show. But he does say in the end here, yes, I'm proud to say that is my real name. So I guess Austin Beerwinkle is his real name. Congratulations to that. He listened to our episode. He wrote in that epically long treatise about defending delta as a probability, a mathematical probability. He had this debate with his friend in a bar, which is where all good debates start, of course. And then it spilled over onto our program. Austin, when he heard his question answered on the show, he wrote in to say, "That's so cool." Haha, loved how it went down on the show. My friend was cracking up too. I was playing it for my wife. And when Dan was like, "Jesus Christ, man, that was a long question," she was like, "Yeah, Dan, try being married to him." Laugh out loud. So epic. But seriously, enjoyed the solid feedback, and sounds like I've got some useful homework to do before I reply. I will be back though and tell them thanks. And yes, I am proud to say that is my real name. So there you go, Dan. You, and it sounds like Austin's wife are on the same mind there, that maybe he's a little long-winded, sir.
Hey, that's okay. That's how we make our livings too, Mark.
Yes. Keeping the wives happy at the end of the day. If you got to choose between boot camp and the wife, you got to go with the wife there. But I'm glad to see we're on the same page. Sounds like you don't have to make that choice there, Austin. We can all live together here in harmony. Let's see. I'm trying to find. A lot of you guys had questions about puts. Let's just go straight up to the next one here. AJ Falasco wants to know. He says, options drill instructors, including the black-hatted one. Well, I guess that's you, Dan. I greatly enjoyed the episode, Why Are Puts So Blanking Expensive? That was our last episode. A lot of you people seem to enjoy that one. He goes on to ask, the SKEW data that you quoted was very informative. Are there any readily available places to find that data for stocks? Yeah, there are some sources. The problem is AJ, that it's just they're not the most intuitive and useful. Like, for example, one of the off-quoted ones is the CBOE SKEW index, which measures the SKEW of the S&P 500. The problem is, Dan, I'm looking at it right now, it's at 142 and a quarter. Does that number have any meaning to you at all, sir?
No, I don't know what that is.
No, it's completely obtuse. So they've created this index, which sounds good on the surface. They're measuring the SKEW of the S&P 500, but it's quoted in this obtuse notation. It usually gets up to around 150 plus or so on the upside. So it's getting, if you know that, you know it's getting pretty close to that upper band where it usually tops out at, meaning, or I should say, probably meaning that puts are getting a little bit bid. The problem is you don't know. Because that index, not only is it obtuse with how it quotes that data, but also it doesn't tell you where that number is really coming from. Is it because the calls are cheap, because everyone's selling them like crazy, or is it because the puts are expensive, or a combination of the two? You don't know. That's why last week when I was quoting you that data, I was quoting it to you from the tools we've created for our TWIFO program. You guys can check them out for yourselves. CMEgroup.com/TWIFO, TWIFO, or /TWIO, TWIO. You can get all that data for yourselves on the futures options, including the E-mini S&P. And what's useful about that is it breaks it down in separate terms for the call wing and the put wing. So you could see independently how they are moving. Maybe the calls actually got bid up, and that's going to change that SKEW number. And if you didn't see that, if you just see one number for the two of them, you wouldn't know that. So you could see it. It also compares to where the puts were and the calls were the previous week. So you could see the change in both sides of the call wing and the put wing. So that's very useful on the futures option side. Now the question is that readily available for stocks? That's a little where it gets a little bit more challenging there, AJ. Some of your brokers will get a little bit more savvy and they will provide some SKEW tools out there. One of the better places to go out there right now is the What's Trading portal of Trade Alert. Trade Alert is more of a professional grade tool. It's kind of pricey. It's part of the SIBO empire over there now. What's Trading is the more retail friendly version of that. That will tell you what the SKEW is in the call wing and the put wing, and also where they rank from a 52-week percentile basis. So that will give you a little bit more information. If you pull up Apple or Tesla, all these crazy names right now, you can see exactly where the SKEW is on a percentile basis, and that will at least give you a little bit more information. It's not going to show you rate of change week over week or things like that. You could graph it, I believe, if you dig in there a little bit, but that's probably one of my better recommendations. Dan, you have any thoughts for where AJ can go? He wants to get good SKEW data on stocks.
Yeah, I mean, I think the Trade Alert one is that's a great recommendation. That is the most accessible. I mean, back when Mark and I were, trading on the trading floor, I mean, we would use some really high-speed software that's really only available for professional traders, where, we would look at our SKEW every day and say, our up SKEW in blah, blah, blah stock is 0.7, our down SKEW in blah, blah, blah stock is 0.95. That's up from yesterday. People are buying puts. I'm going to sell puts. It was really, really useful for us. And we're always looking at it every day. Honestly, if you're interested in that stuff, take the recommendation, look at the Trade Alert stuff, but you'd have to be trading some pretty big positions and be really engaged, full-time trader to really care about what you're looking at, honestly.
Let's see if we got time for a few more here. Big Brick just wanted us to know that he's buying 19,000 worth of Zoom calls. I'm assuming he means 19,000 dollars worth, not 19,000 lot. That would be pretty sizable, in which case you're a pretty big institutional player here, Big Brick. But 19,000 worth of Zoom calls. Well, thanks for sharing that with us. Sounds like that might have worked out for you. Zoom had a ridiculous day recently. I forgot exactly when this came. This came in yesterday. So between yesterday and today, sounds like you might have done well here, Big Brick. Let us know how your $19,000 worth of Zoom calls. Remember, if it goes your way, take at least some of it off. You don't want to lose to decay what you just made here today. So keep that in mind as you're slinging your $19,000 worth of Zoom calls. I just thought that was a funny one. All right, here, Thomas Morgado. I think we'll take it home with him. He writes to Options Bootcamp. Well, you found the right show, so you passed the first test there, Thomas. He wants to know, are there any educational programs that you suggest? I'm trying to really master some of these concepts, but can't seem to trust any I find online. I'm looking for something that can quiz me with scenarios and problems that cause me to learn the Greeks and candlesticks well. Thanks. All right, candlesticks, a little bit of a different beast. Those are technical platforms. You can probably find a lot of those out there. We're going to focus more on the option-specific side, the Greeks. It's an interesting question, Dan. I remember, again, going back to the old days, back when we were on the trading floor, we actually developed some cool software to train our clerks and all this stuff in real time. It would flash you questions, and you had a limited amount of time to answer, which was trying to replicate the environment you're in the trading floor, where you only have a couple of seconds to really do your analysis and make a decision. It was pretty cool software. Unfortunately, I think that all got gobbled up in the Stafford TD deal. I don't know what happened to it now. That would be pretty cool stuff to have even today, 20 years later, because that was useful stuff, and I haven't really seen its like since. But that said, Mr. Dan, you wrote the book on the Greeks. Can you recommend? Maybe you got something cooking over there at MTM folks can go kick the tires on. You got any? It sounds like he wants like a software kind of guide to help him learn options, sir.
Yeah, I wasn't sure how to interpret that. When I hear programs, I think, when I hear educational programs.
That's this. That's this show. This is an educational program.
Yeah, I mean, or a class. And when he said quizzes, I'll tell you what, man. Our daily group coaching class, like that program, it's a webinar every morning from 9 to 10 Central. And our head coach, John, gives trade ideas out every single day. So it's kind of earn while you learn. But one of the best things, and I think you're going to love this a ton, is a couple of times a week, it's quiz time. And he literally gives you quizzes, and they're tough. He stumps like half the class. Even though our intent of the class is to give trade ideas to help people, get a leg up and make it easier to start making money. The quizzes, I think people like even more than getting the trade ideas. So you can try it out actually by going to markettaker.com/99, markettaker.com/99, and you can actually get a $99 1-month trial. So that's our real special Options Bootcamp price right there.
All right, Mr. P, that music means we'll have to leave it there. Great questions, everybody. We'll get to more of your questions on future shows. Empty the mailbag. We had to just get to the gamma today. It seemed like an appropriate time for that. But yeah, there's kind of a dearth of program. Maybe that's a good idea for a show, Dan. We just call it the Options Quiz Show, and we give people questions, and they have to kind of do it on their honor system, and then they can kind of gauge their own options knowledge at the end. We'll kind of give you the answers and talk it through a little bit, and you could judge, see how you perform. Think that would be popular? I think people would be too skittish about taking a quiz.
Oh man, that would be kind of cool. We'd have to set up like a phone line though or something. How would we do that?
I think we'd kind of do it on the honor system, so we'd do it like on demand. And then they would have to like rank themselves, right? Oh, I got 7 right. I got 4 right. I suck. Something like that. Or do you think that's just too much relying on the audience?
Yeah, I don't know. That could be fun. Like we probably shouldn't give away the $1 million prize, for the honor system winners. But maybe it'll at least help people, have some fun and learn some stuff.
Yeah, there you go. Options quiz show coming to you soon here. Like we didn't have enough programming already to produce here. We'll add one more here to the mix. But good question here, Thomas. If you have some suggestions, of course, kick the tires over there on Dan's platform over there as well. Frequent contributors to our network here, the OIC folks, Options Industry Council, also have some online stuff available. If you go to optionseducation.org, you can kick the tires. I haven't been over there since the new refresh. They may have some online kind of courses. I'm not sure if they have the quizzes. You're very specific about the quizzes. I'm not sure if they have that. So maybe you got to go to Mr. P for that. If you want some additional sources of online learning, that's a good place to go. And it's a reputable place. They're not going to rip you off, which is our first and foremost concern here on Options Bootcamp. But Dan, folks are intrigued. Sounds like they can kick the tires on the quizzes over there in your group coaching. Anything else cooking in the land of MTM? Maybe you got some new books in the works. What else do you want to share with our audience, sir?
Oh, no new books. About a year ago, I was like, you know what? I'm going to write a book on this one thing. And, it's just, you never get around to it. But we are working on great new things. I'm not even going to mention the damn website again because, if I start talking about it, you're going to have to use some more of those Grolixes on your Twitter posts.
So we had to bleep Dan last week. I think we're good on the explicit tag this week, sir.
Yeah, but we actually are, like, when that website launches, we're going to invite everybody to come and join, and it's going to be really super great. There's going to be like a whole free section with, actually really great stuff. Like a few months ago, Kathleen and I went to the local sushi place because it was half-price sushi, and it was like a ball of rice with something that might have been a piece of fish in it. Like, it's like, what is this? Oh, well, it's half price, so, we give you half the. So, like, I realized at that point, if I'm going to have a free section to my website, it's got to be great. And so I put all this great stuff in, and you guys are going to love it.
No half-rate sushi at markettaker.com, listeners. You get the full sushi. Right, Dan? That could be your tagline. The full sushi, markettaker.com. You can confuse people all day long with that, sir.
I kind of like that, Mark.
Get the full sushi, Market Taker, 2 T's. Don't forget the second T over there, markettaker.com. Someday in the not-too-distant future, the new website will be live, and then we'll have a big party here on the show. In the meantime, though, all of you out there, thanks for downloading, streaming, subscribing, for sending in your questions, for listening. We see the numbers, know how many of you are tuning in. We really love all of you out there. Stay safe. Stay sane, and we'll see you back here next week for more of Options Bootcamp.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.